I want to make it short. Risk pool tokens is a concept that we have published about a year ago. We have still not implemented it for some very specific reasons, which are regulatory again. And I just wanted to throw this idea out there, because you know it's been a long day. I'm sure you have got a lot of input. Let me give you a bit more input. So, what is the problem? I want also a bit to practice for tomorrow. When we have this nice unicorn event and we need to answer the question, why do you need a token? So I want to answer this question here once. Why do we need a specific token? And I will start in good venture capital slide manner with the problem. What is the problem? We have heard about this. If we deploy an insurance contract on the blockchain, we need to capitalize it. We need to capitalize the risk pool. And this is actually, I know it's very small print, so I don't expect you to read it. This is the transaction with which we capitalized the very first risk pool that we deployed on September 15, 2016. We capitalized the risk pool of flight delay, the first iteration of flight delay, and we sent 250 Ether to the contract. That was coming out of our pockets, and it was not that much money back then, but obviously this does not scale. So you need to find another way to get this money into the insurance contract. And the proposed solution is tokens. We call them risk pool tokens. It's a class of tokens which works in a decentralized insurance system. And in fact, we have seen a few mentions of this already. So Hugh has mentioned tokens to capitalize the risk pools. We have seen it in a few other systems today. And the concept is relatively easy. So you buy those tokens, and by buying those tokens, you provide capital for those risk pools. And this capital can then be used to cover these long tail risks. When we heard Jake talk about the basic risk model, who covers these long tail risks? In Jake's model, we saw you can sell this to reinsurance, but you can also use tokens for the same purpose. So the token holders, as soon as they bought those tokens, they carry some of the risk in the insurance system, and they get also compensating for sharing these risks and locking up their capital. So in a sense, this serves the same function as reinsurance. And what's even more important, those tokens are clearly securities because they pay out. They give you get compensated for locking up your capital for buying those tokens. And so this is very similar to the concept of insurance-linked securities. Catastrophe bonds are the biggest example. And so it's a security token. You might see why we have not yet implemented this. And to give you a very short and very, very simplistic overview of how we could implement this in a first iteration, and as soon as we have done all the other stuff, we will implement this. The smart contract is deployed, the tokens are issued, the investor buys these tokens, and the risk pool starts to fill up. And when the risk pool is full enough, the insurance contract starts underwriting policies. Every new policy that is underwritten adds to the total risk exposure. We have seen it in Jake's model very nicely. And every policy expiring reduces the exposure again. And the premiums add to the risk pool and the payouts diminish the risk pool. I think that's very clear. The interesting thing is we can set a threshold. We can set the threshold and say, if, for example, the total exposure is higher than all the money that is in the risk pool, the smart contract just stops underwriting, so it won't accept new policies anymore. That's of course extremely expensive. We would have 100% collateralization, and in the end, so if we do this for a limited period of time, we can say a month or so, then when the last policy is expired or paid out, then a certain amount of money is left in this risk pool, and ideally more money is left than was put in by the investors, and then the contract can pay out to the investors, and ideally the investors make a nice gain. So that's the very basic idea. It's a very simplistic process, and especially it's not continuous. So you don't have perpetuity in this very simplistic model. So it has a few shortcomings, but then again, it's really simple. And we strongly believe you need to start with very simple models, need to implement those and learn from it. So this is our approach, and this is what we are going to implement. And the challenges, of course, in my opinion, the main challenge is again legal and regulatory. Who can buy these insurance-linked securities? Who can buy those tokens? Who can buy those securities? And who can sell them? Are we allowed to sell them? To whom? In which jurisdiction? So that's a lot of questions that we need to answer. And then in the end, it's also very important to find out how to balance this with the premiums versus payouts. So how much of the capital gains do you want to give to the investors? How much do you want to use to lower the price of the premiums? So we have a few parameters and a few configuration options to fine-tune the system and to balance those different incentives. But that's one of the nice things about blockchain insurance. We can start playing around with these systems, and I'm looking forward to seeing this in action. And that's it. I want to go up to the roof and enjoy the sunset. Thank you so much for your attention. Thanks for having us.